So good morning and welcome to our webinar on pre-year end tax planning. So this morning we will take you through, I'll introduce you to the team that have joined me this morning, and then we'll take you through year-end tax planning, some remuneration tax planning, inheritance tax, and then we've got a question and answer session at the end. If you look up to the top of your screens, you should see there's a Q&A box. Pop any questions you like in there as we go along, and once we've finished, we'll answer as many of those questions as we can. And if you put your questions in there and we don't get to them live today, we'll try and come back to you after the webinar. So to start with, I'll introduce you to the team. So I'm Lucy Crowe. I head up the private client team at Henderson Logie, and I'm joined by two key members of the private client team this morning, which is Edward Marriage and Darren Wiley. And they're going to take you through all the topics this morning. So I'm going to start by handing over to Edward to get us started.
Thanks, Lucy. Good morning, everyone. So as Lucy mentioned, I will be giving an overview of year-end tax planning. So what can be done before the year end to shore up your tax position. And then we will be looking ahead to the 26-27 tax year and having a look at remuneration planning for owners and directors of companies and how they can sort of structure their affairs in a more tax efficient way. So firstly, I want to highlight some of the key opportunities available as we approach the end of the tax year, which falls on the 5th of April 2026. So as things stand just now, we have about 2 months until the 5th of April, and there are 4 main areas that I want to touch on that can help reduce your tax liability. So the first of these is pension contributions. Secondly, we'll look at gift aid. Thirdly, I will touch on some tax efficient investments such as EIS, SEIS and VCTs. And then finally, we will cover ISAs. So if we start with pension contributions, these are one of the most powerful tools that we have for year-end tax planning. And they work slightly differently depending on whether the contribution is made personally, through payroll, or by your employer. So if we start with personal pension contributions, when you make a contribution into a SIP or a personal pension plan, the contributions are made net of basic rate tax, which means effectively the contribution is coming from your already taxed income. So the pension provider automatically claims an extra 20% relief from HMRC. So if you pay in £8,000, HMRC will top this up to £10,000. And if you're a higher or additional rate taxpayer, you can then claim additional relief through your tax return by extending your basic rate band by the gross amount, which reduces the amount of income that's taxed at the higher rates. So in this example on the screen, your basic rate band is extended by £10,000, and you would save tax of up to £2,800 in Scotland if you were an additional rate taxpayer. So as a result, you've managed to put £10,000 into your pension, and it's only cost you £5,200. So it is a phenomenal relief. For employees, there are sort of 2 main methods for pension contributions. The first of these is the salary sacrifice method. So here your contributions are deducted from your salary before tax is calculated. So your taxable salary is reduced by the contribution. So you automatically receive full tax relief at your highest marginal rate, and that's from income tax and national insurance. So it's a very simple and efficient method to reduce your taxable income. The second method is called relief at source, and this is sort of similar to personal pension contributions. Under this method, contributions are taken from your net pay, so from your taxed income, and then the pension provider will claim the 20% basic tax relief separately, so the uplift. And if you're a higher or additional rate taxpayer, you will need to claim the additional tax relief, the extending of your basic rate band yourself through your tax return. So whether you contribute personally or through payroll, all of these contributions count towards your annual allowance, which is currently £60,000 for the 25-26 tax year. So this is usually the maximum you can put into a pension in any given year. However, you can carry forward unused allowance from the previous 3 years if you wish to contribute more. If you are a higher earner, it's important to note that you might have a reduced allowance due to the tapering rules. And these kick in when your total income and pension contributions exceed 260,000. And this can reduce your annual allowance down to a minimum of £10,000. So if you exceed this allowance, you can be subject to what's called a pension tax savings charge. So it's very important to check that you're within your allowed limits before making any sort of year-end contributions. From an overall financial planning perspective, these contributions don't just reduce your tax bill now, they also move your money into a tax-advantaged environment where the income and the gains can grow tax-free, and employer contributions are not treated as taxable income on the individual. So in a sense, they do multiple jobs at once. They save tax now and they reduce future tax exposure, and they allow you to build long-term retirement funds. The obvious downside with a pension contribution is that you can't access the funds until you're 55. But I think overall, when we think about year-end tax planning, pension contributions are usually the first thing we look at because they're reliable, they're flexible, and they offer some of the highest tax savings available in our tax system. So next, I want to look at sort of a practical example of using a pension contribution to your advantage and avoiding the so-called 100K tax trap. So every UK resident individual is entitled to a personal allowance of 12,570, and in that first slice of income, no income tax is due on that amount. But the personal allowance is reduced by £1 for every £2 of income over that £100,000. And once you get to 125,140, it's fully withdrawn. So within that top slice between 100 and 125, that creates an effective tax rate of 60+% on that band of income. And for Scottish taxpayers, it can be as high as 65%. So on the right here, we have an example of an individual who has income in the year of 125,000. So their personal allowance has been fully withdrawn and they've made no pension contributions. So they have a high tax rate, so £52,000 of tax, leaving them with net income of 72,000, near enough £73,000. So that's an effective tax rate on all of their income of about 42%. If we look at the same scenario in the right-hand column, they have the same net income, but they've made a personal pension contribution of 20,112, which once it gets relief within the pension is grossed up to 25,140. Now, this will reduce their tax significantly to 40,000 because they get their full personal allowance back. But their take-home pay is slightly less at 64,723. So while they're about £8,000 worse off in terms of net income and the amount they can spend, they have managed to put an additional £25,000 into their pension. So overall, it works out to be roughly £17,000 better off. So this is just one example of why pension planning is such a powerful tool, especially at the year end, if you're around that 100 to 125 income tax band. However, Darren will touch on this later because it's amazing for income tax planning, but there have been some changes on the IHT side. So Darren will cover that shortly. Next, if we look at gift aids, now this operates in a very similar way to pension contributions in terms of the tax relief mechanism. So when you make a gift aid donation, the charity is able to claim an additional 25% from HMRC. So if you donated £100, that becomes £125 from the charity. And from your perspective as the donor, the grossed up amount, the 125, extends your basic rate tax band, meaning that less tax is payable at the higher and additional rates. Gift aid, quite uniquely, you can also carry this back to the previous tax year, as long as the donation is made before you file your tax return. So it can be used post year end if you've accidentally strayed into the tax trap, the 100K tax trap, or if you've hit the threshold for high income child benefit charge. It can be somewhat overlooked because although you do receive tax relief, it will essentially cost you money. But if you use it strategically, it can be an effective part of year-end planning, especially if you were looking to donate to charities in any case. So if we use the same example as the pension contributions, if you're an additional rate Scottish taxpayer, if you donate £8,000 to a charity, the charity receives £10,000, but it's only cost you £5,200 to make that donation. So it can be quite useful. Next, we'll have a look at tax efficient investment. So EIS, SEIS, and VCTs. So these are investment vehicles which are specifically designed to encourage investment into smaller, earlier stage companies. And in return for taking on this higher level of risk, HMRC offers some extremely generous relief. So the first of these, EIS, this is the Enterprise Investment Scheme. This offers an immediate 30% income tax relief on the amount invested. So if you invested £100,000, there's an immediate £30,000 off your tax bill for the year. There's also no capital gains tax payable on the sale of EIS shares, provided you hold them for the required 3 years. And there is a cap per year of £1 million you can invest into EIS, or it goes up to 2 million if it's in knowledge intensive companies. So a maximum relief of 300 to 600K in any tax year. Next, we have SEIS, which is the Seed Enterprise Investment Scheme. So this is even more generous, offering 50% income tax relief, and this is on investments up to £200,000 per year. So a maximum relief of 100,000 in any given tax year. So it is more generous, but these companies are even smaller, more startups than EIS. So in a sense, it is even riskier. And finally, we have VCTs, so venture capital trusts. Again, these will offer an immediate 30% income tax relief on investments, and that's up to £200,000 a tax year. And the dividends you receive from the VCTs up to the 200,000 are completely tax-free. So they're very popular with individuals who want tax-free income going forward. I should point out that the relief rate is reducing to 20% from April 2026. So if you are considering a VCT investment, it's probably important that you do it before the year end as opposed to after the 5th of April, because you will lose out on that additional relief. Finally, I'll touch on ISAs, or individual savings accounts. So every adult has an annual ISA allowance of £20,000 per tax year. And that allowance resets on the 5th of April. So it's a use it or lose it allowance. And you can use this across both a stocks and shares ISA and a cash ISA, or a combination of both. The major benefit of an ISA is that any income or growth inside the ISA is completely tax-free. So there's no income tax on interest or dividends, and no capital gains tax when you sell your investments. So for people who built up sort of taxable investment portfolios, who want to reduce their future tax exposure, it can make a very big difference over time. One thing to be aware of is the upcoming rule change from the 6th of April 2027, so not this year end, but the next one. The cash ISA allowance for those under 65 will be capped at £12,000. But the overall ISA allowance is going to remain at £20,000. So if you want to maximise your relief, you're going to have to invest at least £8,000 in a stocks and shares ISA. So this is essentially part of the government's plan to make people invest more in the economy. There's also a junior ISA, which is available for children under 18. This has an annual limit of £9,000 per year, and this has exactly the same tax-free benefits as the normal ISA. So this is just a really useful way for parents and grandparents to build long-term tax-efficient savings pots for their children, be it for university costs or home deposits, etc. Next, I'm going to touch very briefly on capital gains tax. So while there is a exemption, it is only £3,000, so it's significantly lower than it used to be. And again, it is strictly use it or lose it. So if you don't make use of it before the 5th of April, then you can't carry it forward. So if you do have some gains that are sitting there and you want to realize these without paying any tax, it's important to do that before the end of the tax year. And I'll touch very briefly on EIS and SEIS reinvestment relief. So with EIS, you can defer a gain of any size by reinvesting that gain into qualifying EIS shares, and you will then get the income tax relief that I touched on earlier. But with EIS reinvestment relief, it freezes the gain and pushes it forward into the future until you dispose of the EIS shares. So this can be quite useful if you expect to be in a lower tax band in the future, or if you simply want to delay paying the CGT. But there is always the danger with EIS reinvestment relief that by the time that you sell the EIS shares, the CGT rate has gone up. So it is somewhat of a gamble. SEIS reinvestment relief, again, it's even more generous. So this 50% of the reinvested gain becomes permanently exempt from CGT. So it can be an incredibly powerful where it fits your circumstances, because that portion of the gain is never brought back into tax. So even though, just to summarize, even though the CGT exemption is very restricted, you can't take it with you to the next tax year. So it's important to utilize it now. So now we've had a look at sort of pre-year end planning. I want to take a look forward to the 26-27 tax year, and specifically for directors and owners of businesses and how they can extract value from their companies. Because remuneration planning, it's not a one-size-fits-all exercise. And the most efficient strategy always depends on your income level, the company's profitability, your wider household income, and your long-term financial goals. So for owner-managed businesses, there are a variety of methods for which the directors can choose to pay themselves with. So salary is the most common, and it's useful because it does give a corporation tax deduction within the company, and it means that the director will qualify for state pension credits. But it can be the least tax efficient method, because once you go above the lower thresholds, both employer and employee national insurance applies. Bonuses, they're treated exactly the same as salary, and they go through PAYE. Benefits, things like cars or medical insurance, these can be valuable, but often they will come with benefit in kind tax charges. So we need to consider these carefully before going down that route. And then dividends, which are usually the most tax efficient way for directors to extract profits, as there's no national insurance on dividends. However, they are paid out of post-tax profits, so there's no corporation tax deduction. And I think it's important to note that from the 5th of April 2026, the dividend tax rates will be increasing. So if you're a director and you already have a remuneration structure in place, it's important to revisit this calculation to make sure you're doing everything as efficiently as possible. Then there are directors' loans. So this is when the company loans money to the director, which has no income tax implications on the director. But if it's not repaid to the company, there is a temporary tax charge within the company at 35.75%. So it does need to be managed properly because it can affect the cash flow. And finally, pension contributions. These remain one of the most tax efficient extraction methods because they're deductible for corporation tax. There's no national insurance and nothing is taxed personally on the director when it goes into their pension. And sort of overall, remuneration planning is about finding the right balance between these options to keep your tax burden as low as possible while meeting your income needs. So here I just have a quick example of what this looks like. So on this slide, we have a company here which has made a profit of £150,000 before corporation tax. And these scenarios basically show you the different methods that are available. So scenario one, the director wants to extract all the money from the company, and he's doing that by virtue of salary. So salary is great within the company because it reduces the corporation tax, but the company also has to pay employers national insurance, and the individual will have to pay income tax on the salary, which is higher, and because of the level, he's also losing his personal allowance. So when it's all salary, this leaves him with a net income of £81,262. If we look at scenario two, this is a much more common example, which we see more day to day. In this example, the director's getting a low salary, so up to the personal allowance of 12,570. So he qualifies for his state pension credits, and then the rest of the funds within the company are being paid as dividends to him. But because dividends come out after tax, there's no corporation tax deduction for that. But you'll see that they would now be left with £85,000, which is basically a £4,000 benefit just by adjusting the way in which they're extracting money from the company. So it is very important to look at. And then scenario three is just a combination of two with a £30,000 pension being paid by the company into the individual's pension. So that's deductible within the company. It goes directly into the pension and it's not taxed on the individual director. And we'll see that under this method, the individual is left with net income of about £75,000. So it's slightly less than options one and two, but he's also managed to put £30,000 into his pension. So overall, it's a net benefit of about £23,500. So this is just to give you a flavor, but as I said, if you are a director of a company and you're looking to extract as much value as possible from the company, there are various methods to do this, and it will depend entirely on your circumstances, if you've got family involved in the company, etc., and their circumstances. But as I said, because the dividend rates are changing, it's really important to revisit this planning. So certainly something to pick up. And with that, I'm going to pass over to Darren, who's going to take us through the changes to the IHT rules.
Thanks, Edward. Some very useful tips there, and good morning, everyone. In the second part of this webinar today, as Ed said, I'm going to be looking at some of the inheritance tax changes, predominantly with a focus on the new APR and BPR rules, agricultural property relief and business property relief. But just to touch on, we will just cover the nil rate band and the resident nil rate band, which has been frozen until April 2031. Pensions, which from April 2027, where most unused pension funds will now be included as part of your estate for inheritance tax purposes. And then, as I said, the APR and BPR rules, where 100% relief will now be given on the first 2.5 million of qualifying assets, 50% relief above that, and the fact that it's now going to be, that allowance is now going to be transferable between spouses. So firstly, looking at the nil rate band. You can move the slide on, Ed, please. Thank you. That, as most people might be aware, everyone currently has an exempt amount from inheritance tax purposes known as the nil rate band. This value is £325,000 and has been that since 2008. On top of that, maybe slightly less well known, is the residential nil rate band. So this is an additional relief that can be given up to £175,000, where you have a main residence and sometimes under certain conditions a former main residence that is then left to your direct descendants, such as your children. This additional relief can be available. It had previously been frozen until April 2030, but in the recent budget in November, it was announced it was going to be frozen for a further year until April 2031. With this fiscal drag and the fact that the bans have remained unchanged, with property prices increasing, other assets increasing, it's likely that more people might be caught by inheritance tax. So it's always worth just getting you that checked if you think you're going to be around that level. Having said that, though, those excess reliefs can be transferred to a spouse or civil partner. So if your wills are mirrored and everything is left to the surviving spouse, excuse me, then those reliefs can be transferred in full. This can give a total nil rate band of 650,000 and a potential residential nil rate band of up to 350,000, giving couples up to £1 million of relief against inheritance tax. It's worth noting, however, that for the residential nil rate band, that where the estate is valued over £2 million, this begins to get tapered. And once the estate for a couple reaches 2.7 million, this is fully restricted to nil. And this is before any other reliefs are considered. Moving on to pensions. Now, we're not going to go too in-depth into pensions today, mainly because these rules apply from the 6th of April 2027, and it's likely we'll have another webinar or an update further in the year highlighting this more, but it's still worth touching on here, is that from the 6th of April 2027, pensions will now be subject to inheritance tax, where most unused funds will form part of your estate. This used to be a very good planning tool previously because of the exempt status that they held. So maybe not quite as good as it used to be or advantageous as it used to be. But having said that, from the income tax benefits that Ed mentioned earlier, pension contributions shouldn't be discounted from that, and still very worthwhile. It just might mean that pensions now need to be considered as part of a wider planning exercise of your estate. For those that have SIPs, and we've not touched on this yet, but we will do, for those that have SIPs or self-invested personal pensions, they might contain qualifying business assets or agricultural assets within them. They will not get the allowance, which we'll touch on in a minute. The government view is that the value of the SIP is the actual value for IHT purposes and not the underlying assets. This means that when those funds form part of your estate, they could potentially be taxable at up to 40% within your estate. It's also worth noting that where someone is over 75 when they pass away, that once the beneficiaries start to draw down on those funds, they will also be subject to income tax. Now, depending on the value or the income level of the individual beneficiary that draws down, that could be taxable in Scotland up to 48% as well. So could be a double tax charge and quite punitive going forward. But it's worth just touching on pensions as part of this. But however, while I say we're not looking at pensions fully, if you do want to discuss pensions, we'd be more than happy to do so now ahead of that. So the main aspect for today, looking at agricultural and business property relief. So when the October 2024 budget came in, it was announced that there would be a £1 million allowance for business property relief and agricultural property relief at 100%. Quite controversial at the time, a lot of lobbying, a lot of demonstrations people have maybe seen on the news, especially from the sort of rural and agricultural and farmers. From there, the other factor was that allowance was not going to be transferable between spouses, which seemed to be out of line a little bit with the nil rate band and the resident nil rate band. In the budget in the following year, November just passed, it was announced that allowance would be transferable between spouses, which was very welcome. But the allowance was still £1 million. And then just before Christmas, without really too much sort of fanfare, it kind of sort of just slipped out in almost like a press release. They announced that relief would be increased to 2.5 million. While that's welcome, that obviously still leaves planning to be required, especially for those people that have got businesses or farms that are valued in excess of 2.5 or 5 million pounds. The remaining assets qualify for relief at 50% and then are effectively taxed at 40%, giving an effective tax rate of 20%. Now, a couple of points to note on that is that That can mean with the allowance, you can gain up to 5.65 million of IHT relief per couple. And that's based on £2.5 million of the allowance for BPR, APR each, the nil rate band being transferred. But the resident nil rate band wouldn't be transferred at that point because the value of the estate is above 2.7 million. So as I mentioned before, that would be fully restricted. And then for those individuals where the first death has occurred before the 6th of April 2026, it's just deemed that that allowance hasn't been used. So that allowance will be transferable to the other spouse. So while this additional allowance is, as I say, is welcome and certainly maybe gives some relief to a lot of individuals and a lot of couples out there, that still doesn't mean planning shouldn't be undertaken. It could be that the value of your remaining assets may still be subject to inheritance tax, or if you've got, let's say, valuations, businesses, etc., that are valued at more than 5 million, planning is still required. So what can you do before the 6th of April? One big one could be trusts. So trusts are a legally separate entity, and while they maybe weren't as effective now as what they previously were, we are seeing a lot more of an uptake and a lot more of interest in them, especially with discretionary trusts, which is what we see mainly. Reasons why trusts can be effective as they can, as I say, because they're a legally separate entity, they can be protective of the assets you put into trust. If you're a settler into trust, while you can technically be a beneficiary, there's various tax reasons why that maybe wouldn't be recommended. But if you have a young family, especially young children who are maybe under 18 that you expect to maybe be part of the business or, you know, as part of succession planning going forward, they could be beneficiaries of that. And it still allows you could still be a trustee, and that still allows you to control the assets that are in the trust. So effectively removing that from your estate, but still being in control of them. And then, as I say, provide the IHT mitigation by putting that in there. Trusts aren't for everyone, however. There are things to consider. In a discretionary trust, there's potential for entry charges putting assets into trust. There's ongoing charges every 10 years on an anniversary, and potentially exit charges when you take assets out the trust. However, when a trust is set up, and while there's other rules, if a settler was to open more than one trust, but assuming just one trust gets opened, that trust would also have its own £2.5 million allowance for BPR. And then, while it's maybe important now before the rules come in, is that you can put an unlimited amount of BPR, APR qualifying assets into trust, although you would need to be mindful of that 2.5 million cap when that comes in for 10-year charges, etc. But that can mean you could potentially put £2.5 million into a trust, not pay any inheritance tax charges on the way in. If it's an asset that maybe isn't going to increase in value, that is unlikely to then have a tax charge at the 10-year anniversary and then on subsequent exits. But there is things, as I say, to consider with trusts. Trust needs to be registered with the Trust Registration Service. Then, depending on the nature of some of the assets in the trust, it might need to be registered for the automatic exchange of information, which it was a bit of a surprise towards the end of last year, but it's a new registration. We can help with both of those if that was something you were needing to do. And obviously with the time frame it's needing, because it's a legal entity and would need a trust deed, a solicitor would need to be involved, so you would need to ensure timing could be done for that. But what that can do is, if you have a couple who has a business that says worth £10 million, for an easy example, the husband and wife could each put £2.5 million of qualifying assets into a trust each. That takes £5 million out of their estate, can save £1 million of inheritance tax on the couple, and still protect things for the future. A different option could be restructuring. You could decide that if you have family members maybe over 18 that you were looking to maybe do succession planning anyway, you can maybe bring them on board into the business earlier than you originally planned. That could then utilise their £2.5 million cap as well as your own. And then you could still restructure that and maybe set up a different share structure within that could allow for alphabet share, so you could still protect your income and your remuneration planning in ways that Ed had touched on previously as well. It might be a case as part of any of that trust, whether that's using trust or doing a different restructuring, an opportunity to look at your actual assets that you've got, reposition them, see what qualifying assets you've got, maximize the 100% relief, and maybe look at other ways of looking at your estate to minimize your inheritance tax. As part of that, that could be gifting. So if you don't do that, look at using your annual gifting of £3,000 per year as a minimum. But if you were looking at doing bigger gifts, so you make regular gifts, say out of income, then make sure that you're reviewing that or documenting that well, just so it's clear what your intentions are. And then ensure that as part of all this, that your wills, letter of wishes, ownership structures are all aligned to make sure that everything is as you intend it to be. So what to do as part of that planning option? I say, review your assets. We can help you do that. So that could be creating a statement of assets that we can help with in terms of showing what your value of your estate is, what your potential inheritance tax liability could be, and ways to help minimise that. It might be as part of planning, especially if you're looking to gift before the end of the tax year, that valuations might be needed where appropriate. So for land, that could be through surveyors. If you're looking to value a business, we've got an excellent corporate finance team who can help you with that. We'll come up with a valuation for your business that you can then use as part of whatever planning you're looking to undertake. A big one, confirm the reliefs available and consider other reliefs. For BPR and APR, you have to qualify, and there's qualifying conditions for that. They could probably do another webinar on what those are, but essentially there's certain criteria you need to make to ensure that the assets are qualifying for those reliefs. We have experts that can help determine that, help give you an opinion as to say, yes, we would think they would qualify or not, and provide advice and ways in which you can solidify that requirement going forward. You can consider ownership splits, as we've already touched on, in terms of utilising the family more to share out the allowances, to bring on some of that succession planning earlier, or gifting that. And that could be in conjunction with evaluating trusts. Look at potential restructuring. As we touched on before, again, looking at your share structure, looking at ways of revaluing what you need to do as part of any overall planning. If you have spare assets or spare cash, we have a financial planning team who could assist with some of that, maybe manage that in a way for you that's more tax efficient, more just efficient overall in terms of your income levels, and help make decisions on where you want your assets to end up. But what I would say on top of all that, though, is that, well, tax is very important. Your family is the most important thing, and it's what's right for you and your family. We would never always suggest tax is the main driver. It should be what you want to do for your family and how you want to make it best for your family going forward. Because ultimately what we want to do is help you get your assets to the right people in the right way. And with that, I'll hand you back to Lucy.
Thank you very much to Darren and Ed for the presentation today, and we hope you find that helpful. To kick off with a couple of the questions, one of the questions we've had a couple of times is, will the slides be available? Yes, both the slides and the recording of today's webinar will be available after we've finished. And there's also our tax planning guide, so anyone who's not got a copy of that, we can get a copy of that sent out to you as well. And that goes into perhaps even more detail on some of the topics that we covered here today and lots of other topics as well. One of the questions that we've had, tax is one of the reasons a lot of people talk about for leaving the UK just now. Do we have expertise for tax liabilities in other European countries? At Henderson Logie, we specialise in UK tax. We do have international experts who can help you coordinate that between different tax jurisdictions. But what we would do is look at your tax position as someone leaving the UK or coming to the UK, and you would then need an expert in that other country or whatever countries you would be potentially taxable. We would work with them to make sure everything's aligned, and we are part of a great network known as Prime Global So we can find you experts in pretty much any country in the world and put you in touch. So no, we don't have experts here who could advise on tax in other countries, but it's certainly something we can coordinate for you. If there are more questions, do pop them either into the Q&A box or the chat box. One question, if you've got, you mentioned putting assets in trust for minor children. Do you have other examples of where we might use trusts? The question here is looking at potentially older children that are getting married. Would trust be useful there?
Yes, trust can be useful for that, because you can use that to protect. So if you've got a family member that's looking to get married and you maybe want to protect assets, so maybe you don't necessarily want the husband or the wife or whatever way around to maybe have access to those assets. A trust can be useful again to keep that protection in place, and just keep your son, daughter, whoever that would be, as the beneficiary, and that just could be left in there to trust at some point for them. They could still benefit from potentially income from the trust, but the underlying asset and the value still could be kept there as a protection mechanism in the event of a future breakup or a marriage or something like that. Not that we'd hope that would happen, but potentially if something like that was to occur, it keeps that protection there if you're wanting to ensure that the business remains solely within the immediate family and not exposed to anybody else. I think on top of that as well, there is other trust available for vulnerable individuals. So if someone's got a son or daughter that's maybe got a disability or maybe some other vulnerability, trusts can be a useful way to still protect those assets for them, but still allow them to benefit from that at a future point in time.
That's great, thank you. And another question was going back to the remuneration planning. So this is probably for you, Ed. You mentioned a lot about the differences. Are you seeing more people looking at the remuneration planning or not yet?
Yeah, absolutely. I mean, it is something we do a lot at Henderson Logie, and basically because of the budget, because of the changes that have happened, and we need to relook at this again for a lot of our clients, because they would have had a specific structure in place that's lasted reasonably well over the last few years, but because of these changes, it certainly needs to be revisited. And I think the thing with remuneration planning is there's so much scope for what you can do because of all the different ways to pay yourself. If you're the owner of a company, you can direct funds to different family members, to children, etc. You can pay pension contributions out, and you can basically really emphasize the amount you can extract from a company if you do proper remuneration planning can be far in excess of what you would have got if you just did the standards, paid yourself a salary and a few dividends sort of thing. So it is very much an area that clients are keen to look at, because you see the benefit almost immediately in terms of how much money they get. So yeah.
That's great. And I think that's the last of our questions just now. If anyone does have any last questions, pop them into the Q&A because we will be able to see these. Other than that, I think it just remains to thank you all for joining us today, to thank Darren and Ed for their presentations, and do get in touch if you've got questions or you want to follow up on anything we've talked about today.